we know that striking at all three of the big three is unprecedented, but right now we're seeing targeted actions. We're just a fraction of the overall 140,000 workers are striking right now. Is this creating a broader economic impact right now with these targeted strikes?
No, it's not. The fact that it's a staggered strike rather than all three and all workers walking off at once, it means that it's going to be much more limited than we would originally expect if all three had shut down.
All right, so if we see a full-blown strike, again, that's about 140,000 workers. One estimate is that would have a $5 billion negative impact in the first 10 days. Where will we as consumers see the big impact? And also, would this potentially impact inflation, something that the Fed is watching closely?
Yeah, that's an important point. Yeah, so the first place that we may see change for consumers is going to be in the used vehicle prices. Used vehicle prices are much more sensitive to changes in the number of vehicles on the market. And when there's less new vehicles on the market, that means there's going to be less used vehicles. There's less choice out there. The new vehicle market, that will be a little bit more delayed in terms of prices.
What about the broader inflation story? So you're saying that used vehicle prices will rise. Will we see inflation in any other areas outside of that? Or does that trigger inflation in other areas?
We don't expect it to trigger inflation in other areas. And we do expect the Fed to see through what is a short-term story. It's short-term in terms of the number of months that it happens. And prices should come back down as production ramps back up once an agreement is reached.
Okay. Long term, if we continue to see this labor disruption, whether it's targeted or a full-blown strike, what does it mean for these automakers? What does it mean for this transition to EVs? And again, for the broader economy to have this kind of disruption? There's many investors who are worried about wage inflation. Is that something that investors should be mindful of going forward?
So that hasn't been the focus of our research. Our research is mainly focused on the impact to the economy. We expect that this is having about a $45 million per day impact on the economy. However, that's spread out, and that's at current rates. And if it goes all the way up to all 140,000, that could be almost $450 million per day to the U.S. economy. And so investors should be worried about that impact to the economy, but it's not going to put us into a full-blown recession. Our main concern is the other things going on. So we just talked about oil prices on your program. We also talked about the government shutdown, Bertha. And so all of these things combining along with student loan repayments starting, that all risks adding to each other to be able to maybe start a recession. However, our thought is that this drag isn't going to be enough, but it do increase the risk substantially to the economic recovery.
You know, really, that's interesting, Mike. I've heard a lot of people talk about it hitting GDP, but you're saying it would raise recession concerns. Kind of spell out how that all happens there. Again, you're saying it's not having a big impact right now, and you even said that the Fed would see it as a short-term issue. How does it then potentially trigger a recession?
So if you have all these things happening at once, you have oil start to go over $100, that puts gas prices above $4, that hits consumer sentiment at the same time that student loan payments re-hit, which brings back spending, and then you have the strike, which we see could have as much of an impact as 0.3% on GDP in the quarter. And if you have all these things combining at once, you could see consumer confidence decrease, which could lead to a decrease in spending.